Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. This month has seen an absolute frenzy of deal-making on the Australian share market. At the larger end, the board of Sydney Airport has rejected a $22 billion bid from a group of infrastructure investors, while Seven Group conducted a masterclass in staging a takeover of Boral without paying much of a premium. There's been plenty more, with corporate action involving Telstra, Tabcorp, AGL, Spark Infrastructure, Ramsay Health, Premier Investments and Myer, Westpac, Challenger Limited, Crown Resorts and the Star Group, just to name a few. It's a combination of pent-up demand and low interest rates. Well, I think it is, but is the money being well spent? And what does it all mean for investors? Roger Montgomery is the founder and chief investment officer of Montgomery Investment Management. Roger, welcome to Fear and Greed.
It's great to be with you guys. Thanks for having me on the show.
So how do you characterise the last month or so?
Oh, it's not the last month. It really is this year. So we're on track with the number of deals and the value of deals that have been conducted since the start of the calendar year. To June 30, we're on track for about $85 billion worth of deals. And if it continues to accelerate as it has been most recently, particularly over the last month or two, then we could break the record we saw in 2011, where it was about $134 billion worth of deals. So it's a function of a number of things. Low interest rates obviously have a lot to do with it. But perhaps more importantly, it's the fact that we're in a low growth world. Low interest rates are likely to continue, and that's a function of very little inflation. And I say that because I don't believe wage inflation is going to take off anytime soon. And if it does, it'll be transitory. And so in that environment, companies are looking, particularly super funds, are looking for income streams that are reliable, annuity style, and if I dare say, boring. And so we thought at the beginning of the year that that combination of factors would lead to a big year of M&A. It was confirmed through some friends of mine that work in the commercial law space that they weren't taking holidays between Christmas and New Year. They were working through. And that was pretty much for me confirmation that we were going to see a big year of takeovers and corporate activity. And that's exactly what you described in your introduction. It's exactly what we've seen so far, and it's likely to continue.
So how big a role are the super funds playing?
Well, you've got to remember that they are trying to enhance returns to their members. If you go overseas, members are getting returns in the very, very low single digits. And so in Australia, a lot of our stocks, particularly the boring income stocks, are priced on yields of maybe 3.5% or 4.5%. They can pay a substantial premium to that and still deliver to their members 2.5% or 3%. And that's darn sight better than they can get outside of that super fund. And so you can see why the argument stacks up to buy things that are listed in Australia.
So the question is, though, are they paying too much? And I think there was an article about Telstra Infraco being bought by super funds as part of a consortium. The argument there being that they actually paid a fair bit, and so much so that Telstra decided not to float it at all. It may as well just do a trade sale. Are the prices a bit toppy?
Well, you do, as a seller, you do intend to feed the ducks while they're quacking, so to speak. So, you've got a more knowledgeable seller in most cases. They're selling for a reason. They believe the price is very good. But if they underestimate any aspect of the synergies that are available to the buyer, then it could be the value to the buyer is higher than it would be to a passive investor or as a continuing going concern. So there is an element of buoyancy in the market at the moment. There's no doubt about that. And there are pockets of irrational exuberance. But from that, you can't infer that the whole market is a bubble and that all of these deals are expensive. You have to look at each one on its merits. And where, for example, there are synergies able to be extracted, or where the buyer gets the outlook right for inflation and interest rates, it could be that these things aren't expensive at all.
It must be hard for some boards to know whether to say yes or no. You think of the Sydney Airport,
sure,
$22 billion bid, that is trading a lot lower than what it was pre-pandemic, and it's kind of obvious why that's the case, yet they're being offered a big premium. Now, they've come out and said no to it. It must be hard for a board, though. They've got to have the confidence they can get back to where they were.
Yeah, well, in the case of Sydney Airport, it's an interesting one because they're caught between a rock and a hard place. On the one hand, it's a fair price considering the circumstances.
Yep.
With international borders closed and every international passenger in terms of profit probably worth 5 domestic passengers to Sydney Airport, and there aren't any international passengers to speak of. So from that perspective, it looks like a fair bid. But prior to COVID, on an enterprise value to EBITDA multiple, when the stock was at $8.80, it was significantly higher than what's being offered today. So, it might be right for the board to dig its heels in and conclude, no, this is opportunistic given the circumstances. And if we were to sell in normal circumstances, we'd be asking for a takeover premium or a control premium as well, which is not in the price of this particular bid. And so, I can understand their difficulty. They're playing a very serious game. There's a lot more litigation and class actions against boards these days than there was 10 or 15 or 20 years ago. So in order to reach that conclusion, in order to reject a bid of that status or stature, they would have done their due diligence as well and done their work. And, to unanimously recommend shareholders reject, that's a big deal. And they must have a very good reason for believing that's the right approach. And then the skeptic in me says, they want to keep their job too. So there's a bit of that, no doubt.
Yeah. Stay with me, Roger. We'll be back in a minute. My guest this morning is Roger Montgomery, founder and chief investment officer of Montgomery Investment Management. So you talked about buoyancy in the market as opposed to bubble. Yeah. What would cull the buoyancy, do you think?
I think a rapid increase in long bond rates. That's one. Announcements by central banks that they're going to taper their stimulus much more aggressively or their unconventional monetary policy much more rapidly than the market's currently factoring in. If inflation, which is spiking at the moment and is currently expected by central banks to be transitory, I think it will be transitory, by the way, but if it settles well above 2%, then that would be a reason to expect the yield curve to steepen. And if the yield curve steepens, then that has a material impact on the present values of businesses where the earnings are pushed much further out into the future, or where, for example, in the case of Sydney airports, there's just no earnings at the moment, and so the earnings are in the future. An increase in yield or an increase in your discount rate has a detrimentally greater impact proportionately on earnings earned further away in the future or on the more distant horizon than next year. And so that would very quickly change the circumstances or the metrics for a lot of these takeovers. And in that environment, it would turn the tap off or it would certainly go from a strong flow to a drip.
So many of these takeovers are very much based on financial metrics. How do you think about something like a merger between the Star and Crown Resorts, where there's so much noise on the back of the Victorian Royal Commission, the West Australian Royal Commission, the fact that Crown hasn't got a licence in New South Wales yet? I'm not asking whether it's a good or bad thing. It's just how do you factor that into your thinking when they're actually very non-financial metrics?
Yeah, so it really, I wrote a book on this subject. I've put a few chapters on this subject in a value investing book that I wrote some years ago. And it really comes down to the profitability of the equity and what you pay for that equity. So, for example, if you've got a business that's generating 20% return on equity and you pay 10 times that equity, then you're getting a 2% return on your equity or what you paid for that.
Yep.
So really, it just comes down to what multiple of equity you're paying and what profitability you can extract from the business based on the multiple of equity that you've paid. That's all it comes down to. When Wesfarmers, just before the GFC, when Wesfarmers bought Coles, they paid a massive multiple of equity. And I think they paid, I have to go back and have a look, but the business was generating about 23% return on its equity. This is Coles.
Mm-hmm.
It was doing 23% return on equity. But if my memory serves me correctly, I think they paid 8 times equity for the business. So if you divide 23% by 8, you get a really appalling number in terms of your return on investment. And so it came as no surprise to me, and I wrote about this at the time, but it came as no surprise to me that the share price subsequently for Wesfarmers subsequently fell from about $40 or $44 a share. It went all the way down to about $12 a share. And yes, the GFC was involved in all of that, but it got hammered much more than a lot of other stocks. And that's because they overpaid. Now, when they spun off Coles this year, they basically made no return on that investment over that entire period of time.
Yeah.
So it really comes down to just that. What multiple of equity are you paying? And then, of course, another ball in the air or another spinning disc, if you like, is if you're issuing equity to make the takeover, you're issuing your own equity, what premium above your equity are you issuing those shares? It may be that you're diluting the equity per share for existing shareholders if you're not issuing shares at a high enough premium.
Yep.
So, there's a lot of moving parts to it, but that's the framework that I think about.
So if I'm trying to set myself up to be in the best position to take advantage of the activity that's going on, and you've indicated that it's likely to continue on for a little while anyway, it's long as...
I think it will. Yeah, I think this year and next year too.
Yeah. I suppose I want you to dumb it down for me, because I'm not a professional investor. How should I think about it?
Yeah, look, without dumbing it down too much, one easier way to think about it, and happy to do all the math afterwards, but think about themes. And which are the themes that are likely to be in demand? I think, as I mentioned earlier, income, boring, reliable, annuity-style income streams will be in demand. Structural growth is another one. So where a business is likely to continue to grow, irrespective of the conditions for the economy and irrespective of what happens with COVID, they'll be in demand as well for a takeover. So I put companies in the cloud computing space, for example, data centers, is a classic example where it sort of ticks both boxes because you've got structural growth and you've also got a boring, reliable income stream once those data centers are fully tenanted and they're just throwing off cash. So I see businesses in Australia like NextDC or Macquarie Telecoms, for example, being in the sights of large overseas pension funds once they're fully developed and producing that reliable, boring income stream. So I'd think about it in terms of thematics. What are the themes that are going to do well? Where are there opportunities? What stocks or businesses are currently on their knees? Travel, for example. So I see opportunities in travel stocks. Another structural grower is the EV space and the battery metals. I note that Nev Power, who was, the former Fortescue CFO, he's just announced that he's joining, or actually it's been talked about for a year or so, but he's joining a special purpose acquisition company in the United States. And they will specialise in buying copper and battery mineral assets. So, that means that stocks like Pilbara Minerals, Mineral Resources, Oricobra, for example, in Australia, they could be in play if a SPAC turns around and buys West Australian-based or Argentinian, Aussie-based battery metals producers. So, you can do the math, but really in this environment, I think it's about the theme. And so, it comes down to those themes.
Fantastic. Roger, thank you for talking to Fear and Greed.
Oh, no problem at all. Great to speak with you and look forward to talking to you again.
That was Roger Montgomery, the founder and chief investment officer of Montgomery Investment Management. This is the Fear and Greed Daily Interview. Join me every morning for the full Fear and Greed podcast with all the business news you need to know. I'm Sean Aylmer. Enjoy your day.